and welcome to our blockchain technology discussion series. In this series, we are going beyond the buzzword around blockchains and looking at the business model, technology, and ecosystems being built around. We hear a lot about the crypto exchange, Bitcoin, Ethereum, trading, wallets, DeFi, and the tokenizations. But there is one critical component that most users never really see is the liquidity. Think about your experience on a crypto exchange. You open a platform, select BTC USDT pair, enter the amount you want to buy, and click buy button. Your order is executed within seconds. It feels very simple. But behind that simple experience is much bigger questions. What is actually on the other side of your trade? What does the liquidity come from? And what happens when there is not enough buyers or sellers? That is where the liquidity providers and the market makers becomes extremely important. So today we are going to understand this complete ecosystem from both business and a technology perspective. What liquidity is, who provided it, how liquidity provider works, what technology is involved, and what risk exists, and how a new exchange can build its liquidity strategy. So to help us to understand this, I'm joined by our blockchain tech lead, Mr. Anmol. So welcome Anmol on this board.
Thank you, Dinesh. It is great to be here.
Let's start with something every crypto user understands. I open exchange, select the BTC USDT pair, enter the amount I want to buy, and click on buy buttons. So from a user perspective, it looks very simple transactions. So Anmol, what is the actual happening behind the scene?
Now, when you place a buy order, it is the responsibility of an exchange to find someone who is willing to sell your Bitcoin at that particular price. Now, this matching engine looks around the market within its own ecosystem, and this ability to manage the cryptocurrency from buyer to seller is what we call a liquidity.
Okay. So when I click buy, the exchange needs to enough liquidity on the other side of the transactions. So my next question is, what happens if the liquidity is not available?
If there is not enough liquidity, you may not get the price you expect. For example, if you are trying to buy a large amount, you may have to buy from sellers offering Bitcoin at higher price. That means you end up spending more than expected. This spending more is called slippage.
Okay. So now we come to the main subject of today's discussions. If liquidity is so important for us, where does it actually come from and who provides it?
Now, liquidity can come from several sources. For example, professional liquidity providers, market makers, institutional traders, other exchanges or external liquidity sources, and eventually the exchange own users also provide liquidity. And now for a new crypto or centralized exchange, professional liquidity providers and market makers can be particularly important because the exchange may not yet have enough organic trading activity.
So Anmol, we often hear two terms in crypto. One is the liquidity providers, and as you mentioned, another is a market maker. So are they basically the same thing, or there is a difference between them?
They are closely related, but they have slightly different roles. Now, a liquidity providers mainly provide liquidity to the market, meaning they make the buying and selling easier by providing available assets and orders. Whereas a market maker usually take more active role. They continuously place both buy and sell orders and use automated strategies to manage prices, spreads, and their inventory. So there is definitely something overlapping between them. But for an exchange, the important thing is not just the name, it is the understanding what the liquidity partners is actually providing, how they provide it, and what the commercial arrangements looks like.
Okay, so let's take simple example. Suppose Bitcoin is trading around 64,000. So there are sellers around $64.50. So I want to buy a large amount. Then how does liquidity affect my trade?
Now, if there are enough sellers at around $64,050, my order can be filled closely to the price. But if there are only a few sellers at $64,050, my large orders may need to buy Bitcoin from sellers at a higher price, such as 50 or $150 more. So I end up paying a little more than I expect. This difference is called the slippage.
So thank you, Anmol, for your breaking down such a complex topic in such a practical way.
Thank you, Dinesh. It was pleasure discussing with you on the liquidity. I'm happy to discuss more on this platform regarding the cryptocurrency, blockchain, and the influence of AI in blockchain. Thank you, sir.
And to everyone watching this, this is just one of the part of the much larger blockchain ecosystems we are exploring in this series. In our upcoming discussions, we will continue exploring other important components like from the crypto wallets to the exchange to DeFi, smart contracts, tokenization, RWA, stable coins, and AI in the blockchains. Thank you for joining us, and we will see you in the next discussion. Thank you.